Okay, this is Order Flow Trading Course Lesson 11, Order Flow Price Rejection. My name is Michael Valtos. I'm the founder of OrderFlows.com. Before we get started, I need to read through a quick disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. CFTC Rules 4.41 state hypothetical or simulated performance results have certain limitations. Unlike an actual performance record, simulated results do not represent actual trading. Also, since the trades have not been executed, the results may have under or overcompensated for the impact, if any, of certain market factors such as lack of liquidity. Simulated trading programs in general are also subject to the fact that they are designed with the benefit of hindsight. No representation is being made that any account will or is likely to achieve profit or losses similar to those shown. Okay, let's move on. Lesson number 11, Understanding Order Flow Price Rejection. Knowing when the market participants are rejecting price will improve your trading. What you want to know is, you want to know when other traders are rejecting price. If you're in a position, you're thinking it's going to go higher, but price is being rejected, more often than not, the market's not going to go any higher. So you should understand areas where price is being rejected. Think in non-market terms. Sometimes it's easier for people to understand the market when they think of, everyday examples. So when you go to the grocery store to buy food and, on your grocery list is you want to buy some beef. If the price of beef has risen too much, do you buy the same amount? No. What do? You either stop buying it or you buy less. You think of it as you're buying volume and beef slows down until you basically stop buying beef. Usually when the price is too high, you will stop buying the beef. You'll reject the price. Another way to think of it is in terms of dating. You ask a pretty girl several times for a phone number and she keeps turning you down, and eventually you give up. The market is the same. Although there may be a heavy passive buyer or a passive seller, at the edge of a bar, or at the high of a move or the low of a move, the opposing aggressive seller or aggressive buyer will eventually give up in rejection if they can't move the price any higher. Going back to, earlier how I explained, in terms of dating, think about, if you've ever asked a girl to get married, right? Sometimes you're very desperate to get married, just like trading. You're desperate for the market to go in your direction. But if, the girl doesn't want to marry you, no matter what you can do, if she doesn't want to marry you, she doesn't want to marry you. The market's the same way. You want the market to go up, but, if price is being rejected at a level just past where you got long, you can hope and wish all you want, but that's not going to make the market go any higher. So price rejection is important because it answers the trading question, will this level hold or fail? What happens is price gets to a level and cannot follow through. There was no more interest at that level, or price level's just behind it. And, usually a sure sign is the market doesn't want to be at or around that price level anymore. So, you come up to a high in the market, and what's going to happen? Either the market's going to keep going higher, the market's going to go sideways, or the market's going to sell off. If price is going to be accepted, price will keep going higher. If the market is sort of indecisive, the market may go sideways. If price is going to be rejected, the market will go lower. So order flow allows you to see areas where low volume is occurring, which is a sign of price rejection. That's a simple explanation. So, imagine as the market's going higher and higher, but the volume at the highs is getting smaller and smaller, buyers are rejecting those higher prices. So the problem with that especially is this low volume doesn't necessarily mean that price was rejected. Price could have moved through a level very fast not to return there. So, there's going to be times where the market just spikes up and spikes back down. Usually that's due to some external factor. Maybe a stop got triggered. It's not necessarily due to overall supply and demand. So let's look at a chart here. This is a bond chart. The market has going up, and it hits the high here at 746. It starts to sell off, but every time we sort of try to make a run back up at the high, I said we had been in an uptrend. We stop. Okay, what's going to happen? The market's either going to keep going higher, go sideways, or go lower. So in this case, it starts going sideways to lower, and each bar tries to go a little bit higher, but you get less volume. You're getting single prints at the tops of these bars. It's rejecting the prices up here above 160 160.17, 160.16. It's rejecting these prices, and the market sells off. So the power of order flow is that it can show you more than just a price level where price was rejected. It shows you how price is being rejected. So one of the best signs of price rejection is when you circle back to a price again, but on lesser volume the second time. What do I mean by that is, say you have a level that the market looks like it's probably rejecting. If we come back to that level and it's not showing any signs of acceptance, and showing rejection, then chances are the price is going to go in the opposite direction. So here's an example. This is the ES, the E-minis chart. We hit a high here at 836. We got up to around the 1886 levels, came off 4 or 5 points, and we tried to make a run back up. You got a green candle starting to run back up, but the price is being rejected here. You have a single print, you have the ratio, and the market sells off. Okay, it sort of stops, and again, people want to try and take it higher, but again, it stopped here with this at this level with a single print. It's sort of circling around to this area where you have the the price rejection the first time. It does get a little bit through, so this time, the second time, it is trying to get a little bit higher, and it does. But buyers are rejecting these levels above 1883. There's no more follow through, and the market sells off. Now, a common way to trade price rejection is to trade it to a level of price acceptance, which basically translates to you get into the trade around an area where there's price rejection, and you enter at an area where there's price acceptance. While there's nothing wrong with that approach, it does leave money on the table. I think sometimes it's hard to determine where price acceptance is. It's easier to determine price rejection. But order flows will allow you to trade from one price rejection to another. So from an area, rather than going from an area where price is being rejected to an area where price is being accepted, it might be more prudent to go from an area where price is being rejected in one direction versus where price is being rejected in the opposite direction. Because as a market moves up or down, it'll go from a high at the top to the middle area where price is going to be accepted, and then go down to an area where price is being rejected. Wouldn't you rather trade from the high to the low, rather from the high to the middle of the range, and then try and trade it from the middle of the range down to the low? It's just easier to trade from the high to the low. That's where you're going to make a lot of money. So remember, if price was accepted at a certain level, it would trade longer around there or move beyond that level. By reading the order flow, you can see if the market is rejecting that price, because there won't be a flow of orders coming into the market to move the market beyond that price. A perfect example here is a crude order chart, crude oil chart. The market moved up, we hit a high, but price is rejected up there. You only got where's the follow through as you're going higher? You've got 3 lots traded right on the high, and buyers are rejecting these higher prices. There's no more buying interest. Market starts to come off. Again, it tries to poke back higher. Again, it's rejecting price. You can see here in the single print of 2 lots. There's no more follow through. It's rejecting prices above 34.14, and the market sells off. Now, when the market is underpriced or overpriced, the institutional traders generally will come in and buy or sell to bring back the market to a price level where more trade can occur. So what are the signs of price rejection? Well, there's basically 2 signs. And, at first glance, you'll think that they're complete opposites, but, you have to approach it in the same way. It can be low volume at edges of a bar or heavy volume at edges of a bar. Low volume at edges of an up bar occur because there's no longer any more buyers to sustain the move. the market is overvalued. Low volume at the bottom of a down bar occurs when there's no longer any more interest from sellers in selling. So, I mean, think about that. Okay, if a market is on the way up, but there's no more buying interest, what's happening? Buyers are thinking the market is too rich. And conversely, if the market is going lower, what's going to cause the price to turn is going to be that there's no more sellers in the market. Yeah, that technically that isn't necessarily price rejection, but if there's no more sellers in the market, people that are selling the market are thinking, there's no more capacity for them to make any money by selling there. So if they stop selling, they're rejecting those low prices, and the market should, bounce up to a level where they could be happy to sell again. So, here's a 5-year chart, and, you've got a couple things going on in here. You have down here at 812, you got a single print. The market was working its way down, and sellers were rejecting, this area in here. They weren't interested in selling anymore. In this case, buyers came in. You got a few buying imbalances, and the market trades up to again, this level up here where buyers have now sort of changed their thoughts at, above 20.5. They think it's probably too expensive. And the market starts to come off. Maybe buyers are stepping in again, thinking, hey, let's make another run up at this high and see if we can take it higher. But they can't follow through. And what I was talking about earlier, rather than buying from an area down at the low to a level of price acceptance, somewhere in here, you traded from an area of price rejection to the next area of price rejection, down to the next area of price rejection. It's one of those things where rather than necessarily leave money on the table, you can trade it from rejection to rejection if everything sort of sets up that way. So heavy volume occurring at the edges of a bar are also a sign of rejection, even though that doesn't make sense. Most people feel that heavy volume would be a level of acceptance, but when the market cannot get past a level and turns, one side of the market has thrown in the towel. They gave up. They rejected the market. They rejected those prices. When heavy volume occurs at the bottom of a move down, sellers were met with strong passive buying and could not get the market to move past that level and gave up. In the opposite way of thinking, when the heavy volume occurs at the top of an up move, buyers were met with strong passive selling and could not get the market to move up any further until all the buyers gave up. What that looks like on an order flow chart is going to be often heavy volume. Now people say that trap traders, but you got to realize what it is. The market is rallying, and there's heavy volume here. People cannot get the market past this level here at 1910. Eventually, they give up in trying to get it past there, and they capitulate and they get out. You want to consider these people trapped? Yeah, you can. But they most likely got out pretty quick. I hate to use the term trap traders because when people are, when you're trapped in something, it's really difficult to get out. In the markets like E-minis, it's fairly easy to get out. If you think you're trapped and you're getting out, at 3 points, from where you got in, I think there's a problem with the way you're trading. But if people are buying it here at 1910, trying to take it higher, and they realize they can't take it any higher, okay, they're going to reject that price, thinking that the price is up here, they can't get through, and they're going to look to get out and either get out or get short if they think price is being rejected up here, or they're just going to get out and sit on the sidelines for a while. Honestly, when I see something like this here, to me it's a sign of price rejection. The price can't get through it here. For me, it's a sign to get short. So like I said, some traders will say that's not really rejection. Honestly, that's just semantics. When one side of the market gives up, that is rejection. If the market hits a high, and even though there's strong selling up there, the reason the selling is there is because price is overvalued. Eventually, buyers realize this and reject the market. Reject prices at those levels. Okay, and let's get into a bunch of examples here, and just sort of take take you through it. What you have here is, market is okay. We come up here at this level 1123. You got a single print. The market starts trading down, bounces up a little bit, rejects a little bit higher prices here, but then what happens immediately after it? You get a single print. So looking at context of the market, the first time you hit this low, you got 11.99 trading, at this level. Second time you got it, it's only 3. So what is it telling you? It's telling you the second time you're coming down into this low, it's rejecting this low price. There's no more interest to take the market lower, and the market reacts higher. You can make the argument, you sort of take, you have this move down, okay, but you have to read what's going on rather than just, get caught up on one side of the market. You should be watching, the bars as they're forming to understand what's happening in the market. You could be thinking, well, you have a single print here, a single print here. It's indicating that the market is rejecting the price to go higher. Well, it did, but then it also rejected the price to go lower here. So, if you're getting short in here and staying short, the fact that you're looking at this staring at you right in the face, the first time you hit this low, you got 11.99. Second time you got 3. It's much more obvious than what you're looking at up here with this price being rejected. This is really shouting at you saying, hey, you've got first time you got 1100, second time you got 3, it's rejecting the price, and the market has turned around and gone higher. Okay, now this is the 5-year chart, and what's happening here? Okay, the market comes up to this high level here, you get 1 lot traded, and then the second bar after it, you've got another single print, 5 lots traded. The market tried to go back up to see if we could take out this high, but it couldn't. It was met with rejection. Only 5 lots can trade here. There was no more follow through and taking the market any higher, and the market sold off. This is an E-mini chart. We're working our way up nicely. Boom, you get hit with heavy volume right up here at the top. This is a ratio bounds low. The Order Flows Trader is the only software that will give you these numbers. So it's telling you there's heavy volume up here at the top of this move. And what happens after that? And the market starts to sell off. You'll notice this, immediately. It'll show up on your chart. Then, you're watching in the next bar to see what happens. You got a single print here. The market did try to tick up a couple of ticks, and there's no more follow through here. You've got just 5 lots traded, and the market sells off and then sells off, afterwards. But all this will show up, as it's happening in the chart. You could be looking at it right here. You'll see this ratio appear. You'll see in the next bar, price being rejected, and, it's a sign for you to get short. This is a crude oil chart, and what you have. Okay, the market's sort of going sideways. It tries to pop up above this sort of range that we're in, above 31.44. And what happens? You get an aggressive buyers right up here at the top. You're getting a ratio. And where's the follow through? Where's the more aggressive buying coming in here to help move the market higher? It's not there. The market turns around and starts going lower. You got a single print here, although it's not a ratio that I like, but it's a single print nonetheless. The market is trying to make a move back up, as we sort of came off from this high. But prices, again, are being rejected, and then the market just sort of goes sideways to lower. Again, in the crude, similar thing. Market is slowly grinding its way higher. It hits this level. You got some aggressive buying happening here. Where's the follow through? It's not there. Can you consider this heavy volume? Yeah, it's crude to get 100 and something over 100 at the edge of a bar is fairly significant. But then even in the next bar, you see the price tries to come back up, tries to circle back up to this high level, but you got a single print. There's no more buying follow through. So even if you're not convinced in this bar, in this second bar, it's telling you again, buying is being rejected here. You can only people are only buying 9 lots and can't take it any. There's no more interest in taking it higher. Say you're still not convinced. You say, I'm not convinced. I still need more sign. The third bar, you get another single print. The market tries to go higher. It can't take out that high. It's just hanging here. You got a single print, and the market just sells off. Again, this is a crude chart again, and it's similar. Now what I'm dealing a lot with is heavy volume at the highs of a move or edge of a bar. We work our way up. You hit the high here, you get past it, and you got a big buying imbalance right at the top, 3100. People can't take the market past this level. Can't get past this buying imbalance. Obviously, there's somebody in there with a lot of supply to sell. The market came off a bit, and the next bar, again, it tries to go back higher, but it can't. You get a single print, and the market sells off. Here's an ES chart, an E-mini chart, working our way up, and it stops right up here at this high. You got a single print, market starts to sell off. Okay, so you're not necessarily convinced. Okay, maybe you're going to get a little bit of a pullback. You hit a high, you want to get a pullback, and then you see a single print here, and it's telling you the price is being rejected up here. Problem is, you're met with a small print down here, and thinking, okay, I don't know how to read this. Is the market turning or not? Watch what happens. It comes back in here, circles right up to this single print, can't get through it, and sells off. Okay, in the next chart, this is a Bund chart, a German 10-year chart, Bund futures, FGBL, and you come down, you got a single print down here. It's a sign of price rejection, and in this case, you get a stacked buying imbalance right after the area of price rejection, and the market moves higher. It's telling you that sellers, where's the rest of the sellers down here? They're disappeared. There's no more. You can only trade 3 lots down at the bottom. And what happened in this case is, enough people have realized that, hey, they're going to reject these prices below 92, and a lot of buying all of a sudden came in to reject these levels, and the market goes higher. As you're going higher, you're seeing more, more ratios in here, ratio bounds lows. You're seeing people supporting the market. When you see people coming in to support the market, they're rejecting these prices down here. They're thinking, hey, they got to get in and, start buying because they're thinking the price is going higher. So this is a E-mini chart, and what's happening is, you've gone sideways here early, 1020 to 1027, it's a 5-minute period. Market's going sideways. It's not going anywhere. It's trading in this sort of this 2.5 point range. But then it starts moving, and what you're seeing at the bottom of these bars are single prints, and it's telling you that the market now has changed its, its view of price, and it's rejecting this area in here where earlier the market was spending a lot of time. This was the area where price was happy to trade back and forth. Now, as we try to trade back in there, sellers are rejecting these lower prices below 1891, below 1893 as you start to move higher. That's what single prints and small prints will tell you, that sellers are people are interested in selling into the bids are rejecting the prices below these areas of single prints. They're not interested in selling below these areas. So this is an E-mini chart, and again, what you're seeing is you have a small print here. The market is going sideways. You sort of, come up, and again, you get, a ratio. It's close. It's 25, but it's indicating a small print, and the market sells off. It's rejecting prices above, above 1895. You can't go any higher above 1895, and you're seeing, less volume as you circle around back up to these high levels. Usually when you come back into a high level, if you're going to take out the high, you're going to have heavy volume. When you have less volume, often you're not going to get the follow through in the move, and the market will go in the opposite direction. Here's another chart. This is E-minis again, and you work your way up to a high, and you got a small volume up here. You got a small print. This is the ratio bounds high up here, indicating that there's less volume up here near the top, indicating that price is being rejected up here. And you get a selling imbalance again, which will help you indicate that sellers are rejecting these prices up here. If you're still not convinced with that, I think that's pretty obvious. In the next bar, you're seeing, I'll say another run up. You only get halfway up into the bar, and then you hit a small print. Price can't get any higher. And then price goes sideways. Again, you come back, you trade back up to this level of rejection here where you had the 3 prints. This time it's a slightly heavier volume, it's 500. But, it's important is you couldn't get past it, and the market starts selling off. Another ES example. We slowly grinding our way higher. You hit this high right here at 1895. You got 17 lots traded here. You got a ratio of 28. The market can't get any higher. And, the market sort of goes sideways. You make another run up at this high. It gets right up to the same level. Trades less volume, 10 lots. Can't get any higher, and the market starts selling off. And you're seeing price rejection on the way down. They can't take the market any higher than 93. Can't take it any higher than 91 as the market is selling off. Where's the follow through? If you're looking for the market to keep going higher, you want to get past these highs. But when you're seeing, very small volume at the tops of bars as you start heading lower, there's no more buying interest. Buying interest has disappeared. Okay, this one's more interesting. What you have here is E-minis as you're selling off, and really you're seeing just, in this case, you're just seeing heavy selling, but, at the tops of the bars, you're getting, one lot's trading, you're getting all single prints. Usually when you start seeing single prints, what it indicates is there's no interest, trading above, retracing back into, earlier areas where we've been trading. Instead, you're just seeing, very strong selling all the way down. When you have a single print, and, it's really not going back up into the bars. It's telling you that, the move is quite strong to go lower. To catch it down here, I think is much later. You could easily see it happening in here where you got the imbalance and you got, a single print here, or even here, you got the single print. You could easily gotten, how many points, 3 or 4 points out of that move very quickly. Okay, this is a Euro stock, and what happens, we make a high, you got a single print, okay, and you got a selling imbalance. And in the next bar, again, you got a single print. I had talked about imbalances before. I'm more inclined to take selling imbalance near a high or a buying imbalance near a low. And why is that? It's telling me that the market is rejecting at high, it's rejecting higher prices, and you're seeing, strong aggressive selling come in that's causing the market imbalances and getting a stacked imbalance, at the high. If you're at a high, you should be seeing buying, because, you like to see follow through in a move whenever you make a high. But there's going to be times when, the move can't sustain itself and the selling comes in. And when you see stacked selling imbalances, around the high, it's telling you that, people have rejected those high prices. When you see single prints up near the high, it's telling you the buying has dried up that can't necessarily take it any higher. So here you hit the high, got a single print, and then a single print, and a small print. You got these 3 things lining up. Even if you're not even paying attention to the selling imbalances right up here at the high, the fact that we hit the high on a single print, sort of tried to make a run back up at the high, but couldn't sustain it, and you got a small volume number, a single print. It's market is, pleading with you, that's saying, hey, you should sell me. I can't take the market I'm not going to go any higher. In the third bar, you see a small print, and the market sells off. Okay, so this is a Euro stock, and what are you seeing here? Okay, you have a selling imbalance right here. Okay, this green line is the high, and markets come off. You got this big, strong selling imbalance, and what's happened? You get a single print on the just outside of it, and another single print. Okay, if you're convinced that strong selling has come in, but is indicated by the stack selling imbalance, well, don't be mesmerized by the selling imbalance, stack selling imbalance just because it occurred. You gotta realize, you gotta watch what's happening in the market. Okay, you got a single print here. We're trading back inside the imbalance. Why isn't the market selling off? Then you get another single print. There should be strong selling to move it lower, but sellers are rejecting the area below 22. As you see, two single prints here. And then the market just turns around and goes higher. If we can't get through these single prints, the market is telling you something. So even if you're getting short based on the stack selling imbalance, the fact that we couldn't get through these single prints, the market's rejecting these prices below 20. People were all expecting the market to sell off, but it's not. There's no interest to sell it below 20. The prices below here, below these two single prints, are being rejected. Okay, Euro stocks again, and what happens? You're up here around the high. Okay, you got a you got a heavy volume here, but then you hit the high again, and volume's okay, it's 38, but then immediately afterwards you get a single print. So it's telling you that you hit the high, you start coming off, you're making a run back up there, but buyers are rejecting these prices. The buyers aren't interested in taking it any higher, and the market goes lower to sideways. Euro stocks again. Okay, you're right up here near the high, and what happens? You get it within a tick of the high, you get a single print. Where's the follow through? You got buying imbalance here, you got buying imbalance here, but if everyone's so aggressive at this level at 51, why aren't they aggressive at 52? They're not interested anymore. The market comes off a little bit, you get another single print. Now you're trading 50. Okay, you can only get one person interested to buy it there. The market just sort of goes sideways again, gets back up to this 51 level, and just heads off, heads lower. What these two bars here are telling you is people are rejecting these prices above 51, above 50, 51 here. It got up to 51, okay, it tried, but it just couldn't sustain that move. Okay, Euro stocks again as we're heading lower. I said first things first. You have the selling imbalance right at the low. You expect to see selling imbalances at the low. That's what you want to see as you're taking out the lows and making new lows. You expect to see aggressive selling. But what you have here is you hit the low, start rallying back up, but you have some stopping volume here, stopping volume here. Now you're seeing single prints. You're seeing lack of follow through to move the market back up. Instead, what you have is someone coming in and offering size to sort of cap the market. But buyers aren't any more interested in taking the market any higher. They're rejecting these higher prices up here, and people are willing to accept lower prices. Okay, this is another example of Euro stocks. We hit the low. You got a single print, one lot traded right on the low. The market bounced up a little bit, and we got back within, 2 ticks of the low, and you got, a ratio balance low here, indicating some heavy volume here. Second time we test that, we came back down exactly to that price, and you got much less volume. This time you got a single print, 6 lots. So it's telling you, it's rejecting this prices down here. People aren't interested in selling down here. They think, there's no reason for them to sell and keep selling here when they could expect the market to bounce up and, possibly sell higher. Another case of Euro stocks. Why I got a lot of Euro stocks. Yeah, it's a market where, it's a very liquid market. It's a great market for trading. Sometimes, people always ask, well, what's the best market for trading? For me, any market that has decent amount of volume is a good market to trade. So, we hit the high. We got one lot traded right on the high. You've got a, price rejection here. If you're hitting the high and it just ticks on one lot, why can't where's the rest of the buyers to take the market higher? And it just falls right over. Okay, this one, it's a 5-year chart. 5 years are also a very liquid market, but let's just talk about what's happened here. We hit the high. There's nothing special about it. It's just an average high. We start working our way down. Then you hit this area right here where you have very strong volumes, basically to stop the move, and the market comes back up. But you're met with this single print. There's only one lot trades here. Where's the follow through to take the market higher? You have this volume right here to basically support the market, but you start to move away from this area, then it just stops. People are rejecting these prices up here. Why isn't the market going any higher? Instead, it's just rejecting prices above 120.10. And the market starts working its way down. You get confirmation here where prices, you got a single print, prices can't move higher. To a lesser extent, you got some heavy volume at the top of this bar. So obviously there were some strong sellers. People are, have changed their view in the market, and they expect the market to go lower. When we get down into this bar, people that want to try and push the market back up to these levels, test these levels if they're going to hold or not, there's no more interest. Price up here is being rejected. Okay, a 10-year chart. 10 years are a market that is very thick and trades a ton of volume. We hit the low, you got it again. You got 4 lots traded right on the low. It's rejecting these prices below this low, and the market just starts working its way up. You have a single print up here, but it's met with a single print in the opposite direction. Then again, a single print here. It's telling you, price is rejecting this area down here to trade back into this area. Even here, you have a 0 that's traded. Buying was quite aggressive here, or it just was bought up very fast. That you have a 0 at the bottom of this bar. Normally, you'll have volume appearing at the bottom of on the left side of a green candlestick. When you get a 0, it's telling you that there's really some aggressive buying as the market's moving away from the low. So it's rejecting these prices down here. You can see that with order flow. If you're just looking at a bar chart, you just see, a green candle, a green candle, a green candle. You don't know that prices are necessarily being rejected down here, but you're seeing it down, in the order flow. Lastly, here's a 10-year chart again. So you come up to the high. I cut the chart off, so I can't tell what the volume is up there, but that's not important. What's important is you start coming off the high, you get a small print here. You see 19 lots traded. You have a ratio. This is, I spend a lot of time talking about ratios in my software. Order Flows Trader is the only software that will put ratios so you can see if it's a small print, so you can see where price is being rejected. So we came up off the high, and we start making a run back up towards the high, but price is being rejected here because there's no more follow through. Okay, maybe you're not convinced. The market comes down to this next level, trades a bit sideways, but you're seeing a small print. Price can't get through. Now it can't get through this level up here at 128.30, and the market just sells off. I said if price isn't being rejected in this area up here, it'll move back up into the 129.01, 129.02 level. But you can see in the order flow that price is being rejected. When you're seeing small prints, there's a lack of buying, lack of follow through, and the market sells off. You could use these small prints, these ratios, as confirmation that the market is rejecting these higher prices, that buyers aren't interested in taking the market any higher. So that's the end of lesson 11, order flow price rejection. In the next lesson, I'll discuss how order flow can be used to determine support and resistance in the market with real-time market information. I'm not talking about waiting until the market closes and calculating your support and resistance levels. You can be watching the market as it's trading, and you can see in real time where support and resistance levels are being formed by the market. So thank you. That's the end of lesson 11.